जी, अब मैं आपको वाकई तकरीबन 28 मिनट की मुकम्मल इंग्लिश स्क्रिप्ट दे रहा हूँ। यूएस ऑडियंस, ख़ास तौर पर रिटायरीज़ और पीपल अप्रोचिंग रिटायरमेंट के लिए। मैंने उसे अगस्त 12, 2026 तक की ताज़ा इन्फॉर्मेशन के मुताबिक रखा है। जुलाई में फेड ने रेट्स को 3.50%, 3.75% पर बरकरार रखा था और सितंबर 15-16 को अगली एफओएमसी मीटिंग है। एक अहम पॉइंट, 4 सितंबर को अगस्त जॉब्स रिपोर्ट, 11 सितंबर को अगस्त सीपीआई और 15-16 सितंबर को फेड मीटिंग है। इसलिए वीडियो का टाइमिंग बहुत स्ट्रॉन्ग है। If you are retired, nearing retirement, receiving Social Security, living on savings, or simply trying to protect the money you worked your entire life to build, there is a date you need to know about. September 15th and September 16th, 2026. Those are the dates when the Federal Reserve is scheduled to hold its next major policy meeting. And this September meeting could become one of the most important financial events of the month for American households. Because the question is not simply whether the Federal Reserve will raise interest rates, lower them, or leave them unchanged. The bigger question is this: what will the Fed's decision mean for your savings, your CDs, your bonds, your investments, your borrowing costs, and your retirement strategy? And right now, the situation is unusually complicated. Inflation is still above the Federal Reserve's long-term 2% target. At the same time, the labor market has shown signs of losing momentum. And inside the Federal Reserve, policymakers are not necessarily looking at the economy in exactly the same way. So September could bring a very important decision. And if you are a retiree, you should not wait until September 16th to start paying attention. You want to understand what is happening before the decision arrives. Let's start with where things stand right now. The Federal Reserve currently has its federal funds target range at 3.50% to 3.75%, after leaving rates unchanged at its July meeting. That July decision was not completely boring. 3 FOMC members dissented and preferred a quarter-point rate increase. That matters because it showed that there is already disagreement inside the Federal Reserve about how much pressure is still needed to control inflation. So when people say the Fed is definitely going to cut rates in September, that is not something you should treat as a fact. And when somebody says the Fed is definitely going to raise rates, that is not guaranteed either. The real story is that the Fed is watching the incoming economic data very closely, and the next few weeks are packed with important data. The August jobs report is scheduled for September 4th. Then, the August Consumer Price Index, or CPI, is scheduled for September 11th. And only a few days later, the Federal Reserve meets on September 15th and 16th. That means the Fed will have some of the most important new information available to it just days before its decision. So let's talk about why those reports matter so much. First, jobs. The U.S. labor market has been showing signs of cooling. The July employment report showed that non-farm payroll employment declined by 23,000, and the unemployment rate was 4.1%. That does not mean the American economy is collapsing. It does not mean millions of people are suddenly unemployed. But it does mean the Federal Reserve has to pay attention. Because the Fed has 2 major responsibilities that matter here: price stability and maximum employment. That means policymakers cannot simply look at inflation and ignore the labor market. If inflation is too high, the Fed may want to keep monetary policy restrictive. But if employment begins weakening significantly, policymakers have to consider whether keeping rates too high could put unnecessary pressure on the economy. And that is where September becomes so interesting. Now let's talk about inflation. The latest July CPI report showed consumer prices rising 0.1% from the previous month and 3.4% over the previous year. Core CPI, which excludes food and energy, rose 2.5% over the year. So inflation has not disappeared. And that is incredibly important for retirees. Because retirees experience inflation in a very personal way. You don't experience 3.4% inflation. You experience higher prices at the grocery store. You experience higher insurance premiums. You experience higher housing costs. You experience utility bills. You experience healthcare expenses. You experience the cost of maintaining your car. And you experience the cost of everything else you need to live. That's why inflation can be particularly painful after retirement. When you are working, you may have the ability to increase your income by working more hours, changing jobs, asking for a raise, or building a business. But once you are retired, your income may be much more fixed. You may have Social Security, you may have a pension, you may have retirement account withdrawals, and you may have interest income. So when prices rise, your purchasing power can fall. That is why the September inflation report could be extremely important. The August CPI report is scheduled for September 11th at 8:30 Eastern Time. That is just 4 days before the Fed meeting begins. So imagine this scenario. The August CPI report comes in hotter than expected. Suddenly, investors may worry that inflation is becoming harder to control. That could make a September rate cut less likely. It could even increase discussion about keeping rates higher or, depending on the data, raising them. Now imagine the opposite. Suppose inflation comes in softer than expected. That could give the Fed more room to consider a less restrictive policy. And investors could start thinking more seriously about future rate cuts. But there is another piece of the puzzle: jobs. Suppose the September 4th jobs report shows the labor market weakening significantly. Now the Fed has a completely different problem. Inflation may still be above target, but the economy may be losing momentum, and that creates a difficult decision. Do you keep rates high because inflation is still too high? Or do you become more cautious because the labor market is weakening? This is why you should not look at one economic number in isolation. The Fed will look at the whole picture: inflation, employment, wages, consumer spending, economic growth, financial conditions, and the risks surrounding the outlook. The September meeting is also associated with a summary of economic projections. That is important because 4 times a year, the Federal Reserve releases projections covering GDP growth, unemployment, inflation, and the appropriate policy interest rate. So September is not just about the interest rate headline. It could also give investors a new look at how policymakers see the economy moving forward. And that could be just as important as the rate decision itself. Now let's bring this back to you. If you are a retiree, what does all of this actually mean? Let's start with savings accounts. If you have a significant amount of cash sitting in savings, interest rates matter. When rates are relatively high, savers can earn more interest than they could during periods when rates were near zero. That can be helpful for retirees who want income without taking stock market risk. But there is a catch. If interest rates eventually move lower, banks may lower the rates they offer on savings products. That means the interest income you are receiving today may not last forever. This is why retirees should pay attention to the maturity dates and rates on their savings products. Now let's talk about certificates of deposit. CDs have become particularly interesting in a higher rate environment. You put money into a CD for a specific period, and in return you receive an agreed-upon interest rate, subject to the product's terms. But what happens if rates fall? When your CD matures, the next CD you purchase may offer a lower rate. That means a retiree who depends on interest income needs to think beyond today's rate. You need to think about what happens when that rate expires. Some savers use a strategy known as a CD ladder. Instead of putting all their money into one CD with one maturity date, they spread money across different maturities. The goal is to create a schedule where money becomes available at different times. That can provide flexibility if rates change. But remember, there is no one-size-fits-all strategy. The right approach depends on your cash needs, taxes, risk tolerance, and overall retirement plan. Now, let's talk about bonds. This is another area that can become confusing when interest rates move. Bond prices and market interest rates generally move in opposite directions. When market rates rise, existing bonds can become less attractive compared with newly issued bonds offering higher yields, which can put downward pressure on their market prices. When rates fall, existing bonds with higher coupons can become more valuable relative to new bonds. but the actual impact depends on maturity, duration, credit quality, and other factors. So if you have bonds in your retirement portfolio, don't just look at the yield. Understand what you actually own, and understand why you own it. Are those bonds designed to generate income? Are they there to reduce portfolio volatility? Are they intended to fund future expenses? Or are they part of a broader diversification strategy? Those questions are more important than trying to guess exactly what the Fed will do. Now let's talk about the stock market. This is where financial headlines can become extremely misleading. You may hear someone say, "Fed cuts rates, stocks go up." But that is not a guaranteed rule. The stock market cares about expectations. It cares about corporate earnings. It cares about economic growth. It cares about inflation. It cares about interest rates. And it cares about what investors believe will happen next. Imagine the Fed cuts rates because inflation is under control and the economy remains relatively healthy. Investors could see that as positive. But imagine the Fed cuts rates because the economy is weakening dramatically. That could create a very different reaction. Investors might worry about corporate profits and unemployment. So a rate cut by itself does not tell you everything. The reason behind the rate cut matters, and this is particularly important if you are retired. Because retirees generally have less time to recover from a major financial mistake than younger investors. If you are 30 years old and the stock market falls sharply, you may have decades to recover. If you are 75 and depending on your portfolio to pay this year's bills, a large market decline can be much more difficult to manage. That doesn't mean retirees should avoid stocks. It means retirees should understand their risk. You should know where your next few years of spending money are coming from. You should know how much of your portfolio is exposed to market volatility. And you should know what you would do if stocks dropped sharply. Because the worst time to create a plan is after the market has already fallen. Now let's talk about Social Security. There is a very important distinction here. The Federal Reserve does not control your Social Security benefit. The September Fed decision does not directly change your Social Security check. Social Security's cost of living adjustment is determined under a separate formula. But inflation is still extremely important for Social Security recipients. Why? Because the purchasing power of your benefit depends on the prices you pay. And there is another reason retirees are watching inflation closely right now. The 2027 Social Security COLA will be officially determined later in the year. Current estimates are not official and can still change as additional inflation data comes in. Different analysts and organizations have published estimates in the roughly mid-3% range, with some estimates around 3.6% to 3.8%. But remember, an estimate is not the official COLA. The official number will depend on the required inflation data later in the year. So if somebody tells you right now that your 2027 Social Security increase is guaranteed to be a certain percentage, be careful. It isn't official yet. But September inflation data will still be closely watched because it contributes to the broader picture of inflation used in retirement planning. And this is another reason the September CPI report matters. It is not just a Wall Street number. It is a number that millions of Americans will be watching because they want to understand where their purchasing power is heading. Now let's imagine 3 different September scenarios. Scenario 1. The Fed holds rates steady. This could happen if inflation remains above target and policymakers want more evidence before making a major move. For retirees with savings, that could mean interest rates remain relatively attractive for a while. But borrowers could continue facing higher costs, and the market could still be sensitive to future Fed decisions. Scenario 2. The Fed raises rates. That would be a more aggressive move. A rate hike could strengthen the message that inflation remains a major concern. Savings yields could potentially remain higher for longer. But borrowing costs could also remain elevated, and financial markets could react negatively if investors view the move as evidence that inflation is proving difficult to control. Scenario 3. The Fed moves toward a more accommodative position. That could happen if inflation cools enough and the labor market weakens enough to justify greater concern about economic growth. Lower rates could eventually benefit borrowers, But savers could face lower yields on new deposits in CDs, and investors would then have to decide whether the economic outlook supports stronger stock prices or whether the reason for lower rates is itself a warning sign. So which scenario will happen? Nobody knows for certain. And that is something I want you to remember. If someone tells you today that they know exactly what the Federal Reserve will do on September 16th, they are making a prediction. They are not giving you a guarantee. There is a huge difference. Economic data can change. Inflation can surprise. Jobs can surprise. Oil prices can change. Consumer spending can change. Financial conditions can change. And Federal Reserve officials can change their views when the data changes. So rather than trying to predict the Fed perfectly, let's focus on what you can control. You can control how much emergency cash you keep. You can control how much debt you carry. You can control whether you understand the investments inside your retirement accounts. You can control whether you know when your CDs mature. You can control how much risk you are taking. And you can control whether your retirement budget actually works. That is much more powerful than trying to predict one Federal Reserve meeting. Now, there is one more thing I want retirees to watch: the relationship between inflation and income. Suppose your household spends $4,000 a month, and your income is mostly fixed. If your expenses rise by several percentage points over time, you need to understand where that additional money is going to come from. Maybe you have enough savings. Maybe your Social Security provides a COLA. Maybe you have a pension. Maybe you have investment income. But if your retirement plan assumes that prices will stay almost unchanged, inflation can create a serious problem over time. That is why inflation protection is not simply an investment issue. It is a retirement planning issue. Now think about healthcare. For many older Americans, healthcare costs are one of the biggest concerns in retirement. Even if general inflation cools, individual categories can behave differently. That means retirees should not assume that a lower national inflation number automatically means every expense is getting cheaper. Prices can still rise, and some expenses can rise faster than the overall CPI. This is why a retirement budget should have some flexibility. Now let's return to September. September 4th, the August jobs report. September 11th, the August CPI report. September 15th and 16th, the Federal Reserve meeting. And there is another important point. The September meeting is associated with updated economic projections. So investors may get not only a rate decision, but also a new look at how Fed policymakers see growth, unemployment, inflation, and interest rates going forward. That can influence markets well beyond the actual meeting day. And for retirees, it can influence the environment in which you make decisions about savings, bonds, stocks, and cash. But again, don't confuse market news with personal financial advice. A headline cannot tell you whether you personally should buy or sell something. Your age matters. Your income matters. Your expenses matter. Your tax situation matters. Your health and family circumstances matter. Your investment horizon matters. And your tolerance for risk matters. That's why two retirees can see the exact same Fed decision and reasonably make completely different financial decisions. One person may need more cash. Another may have enough guaranteed income and be comfortable taking more investment risk. One person may have a large mortgage. Another may have no debt. One person may depend heavily on CD interest. Another may depend primarily on Social Security. The same Fed decision affects all of them differently. So don't ask only, what did the Fed do? Ask, what does the Fed's decision mean for my specific financial situation? That is the smarter question. Now let's talk about one of the biggest dangers for retirees during periods of financial uncertainty: panic. When the financial news becomes dramatic, people sometimes make dramatic decisions. They sell investments after a market decline. They move everything into cash. They chase the highest interest rate. They buy something because they saw it on television. Or they make a major portfolio change because somebody on social media predicted a recession. That can be dangerous. A retirement portfolio should not be built around fear. It should be built around a plan. And a good plan should be able to survive more than one economic scenario: high inflation, lower inflation, higher interest rates, lower interest rates, strong markets, weak markets, economic expansion, economic slowdown. You cannot control which environment arrives next, but you can control whether you are prepared. And that brings us to the most important question. What should you actually do before September? First, review your cash reserves. Make sure you understand how much money you may need in the short term. Second, review your savings and CD rates. Know when your CDs mature and what happens next. Third, review your bond exposure. Understand duration and the role bonds play in your portfolio. Fourth, review your stock allocation. Ask yourself whether you could emotionally and financially handle a major market decline. Fifth, review your retirement income. Know exactly how much comes from Social Security, pensions, investments, and other sources. And sixth, don't make a major financial decision simply because of one headline. If you work with a financial advisor, this is a good time to ask questions. Not, can you predict what the Fed will do? Instead, ask, how is my retirement plan positioned if rates stay high? What happens if rates fall? What happens if inflation rises again? What happens if the stock market drops? What happens if I need more cash than expected? Those are much better questions, because your financial plan should not require the Federal Reserve to make the perfect decision. It should be able to work even when the economy surprises you. Now let's look at why September could be particularly important for the markets. Investors are already watching the possibility of a rate increase. Current market pricing has recently put more weight on a hold than a hike, but the probability of a September hike has not disappeared. That uncertainty itself can create volatility, and volatility is often what scares retirees. You may open your brokerage account one morning and see a large move. You may hear commentators saying the Fed is too tight. Then another commentator says inflation is too high. Then somebody says a recession is coming. Then someone else says the economy is stronger than expected. It can become overwhelming. But remember, you don't need to react to every opinion. You need to understand your plan. September could be noisy. The market could move. Interest rate expectations could change. Bond yields could move. The dollar could move. Stocks could rise or fall. But none of those things automatically means your retirement plan has failed. The real danger is making a permanent financial decision based on a temporary headline. Now let's talk about the biggest misconception about interest rates. People often think that higher rates are always bad and lower rates are always good. That's not true. Higher rates can be painful for borrowers, but they can be helpful for savers. Lower rates can help borrowers, but they can reduce income opportunities for savers. And the economic reason behind the rate move matters. If rates are high because inflation is persistent, that's one situation. If rates are high because the economy is strong, that's another. If rates are low because inflation is controlled and growth is stable, that's one situation. If rates are low because the economy is entering a serious downturn, that's another. So don't judge the Fed decision without understanding the reason behind it. That is what professional investors will be trying to understand. And it is what retirees should understand too. Now think about the September 16th press conference. The rate decision itself could be only part of the story. The questions asked by reporters, the answers from Fed leadership, the updated projections, the language in the policy statement. All of those things can influence expectations for future meetings. And sometimes the market reacts more strongly to what the Fed says about the future than to the actual rate decision. That's why September 16th may not be the end of the story. It could be the beginning of a new conversation about where interest rates are heading for the rest of 2026 and into 2027. And that could affect retirement planning decisions. Now, here's something else to remember. The Federal Reserve does not control the entire economy. It cannot control every grocery price. It cannot control every oil price. It cannot control global events. It cannot control every company's hiring decisions. And it cannot control exactly how consumers spend their money. So even the Fed has to respond to data it does not completely control. That's why forecasting the economy is so difficult. And that's why you should be skeptical of anyone who claims certainty. Financial markets are forward-looking. They are constantly trying to predict what comes next. And sometimes the market is wrong. Sometimes investors price in a rate cut and don't get one. Sometimes they expect a recession and it doesn't happen. Sometimes inflation surprises everyone. Sometimes employment is stronger than expected. That uncertainty is normal. Your retirement plan should account for it. So as we move toward September, keep these dates in mind. September 4th, jobs. September 11th, inflation. September 15th and 16th, Federal Reserve. Those three events could dominate financial headlines. And if you are a retiree, you should understand why they matter. But don't let the headlines control you. Use them as information. Use them to review your plan. Use them to ask better questions. Use them to understand the environment. But don't let a single number determine your entire financial future, because your retirement is much bigger than one interest rate decision. It is your savings, your Social Security, your investments, your housing, your healthcare, your taxes, your spending, your family, and your long-term financial security. The Fed can change interest rates, but it cannot change the importance of having a financial plan. And here is the bottom line. September 2026 could be a major month for the U.S. economy. Inflation is still above the Fed's target. The labor market has shown signs of cooling. The Federal Reserve is divided on how much additional restraint may be necessary, and markets are watching closely to see whether the Fed holds, hikes, or eventually moves toward lower rates. The latest July inflation data showed prices rising more moderately on a monthly basis, but annual inflation remained elevated at 3.4%. That means the inflation battle is not necessarily finished. At the same time, the recent labor market data gives policymakers another reason to be cautious. And that tension is exactly what makes September so important. For retirees, this is not just an economic story. It is a money story. It is about what happens to the interest you earn. It is about what happens to borrowing costs. It is about what happens to bonds. It is about how investors react. It is about purchasing power. And it is about how prepared your retirement plan is for different economic outcomes. So don't try to predict the future with absolute certainty. Prepare for it. Know your numbers. Know your income. Know your expenses. Know your cash position. Know your investment allocation. Know your debt. Know your CD maturity dates. And know how much market volatility you can actually handle. Because the smartest retiree is not necessarily the person who predicts the Fed correctly. The smartest retiree may simply be the person who doesn't need to predict it correctly. That is the goal. Build a financial plan that can survive uncertainty, because uncertainty is not going away. The September Federal Reserve meeting will come and go. The markets will react. The headlines will change, but your retirement will continue. And that is why your financial decisions should be based on your long-term plan, not on one afternoon of breaking news. So mark the dates: September 4th, September 11th, September 15th, September 16th. Watch the jobs data, watch inflation, watch the Federal Reserve, and most importantly, watch what all of it means for your own financial situation. Because the next Fed decision may be a Wall Street story, but the consequences can reach Main Street. They can reach your savings account, your CD, your bond portfolio, your mortgage, your investments, and ultimately, your retirement. September is coming, and this time, the biggest question is not simply, will the Fed raise rates? The bigger question is, what will the Fed's decision mean for your money? That is the question worth watching. And if you want to stay updated on the biggest U.S. financial developments affecting retirees, Social Security recipients, savers, and Americans approaching retirement, make sure you stay connected to this channel. Because when the next major number comes out, we will break it down in simple terms. No complicated Wall Street language, no unnecessary panic, just the numbers, the facts, and what they could mean for your money. September could be a very important month, so be ready.